In an era marked by escalating inflation, traditional investment strategies may fall short of protecting your wealth and ensuring growth. In an era characterized by escalating inflation, conventional investment strategies may not be sufficient to safeguard your wealth and guarantee growth. The pursuit of investment opportunities that provide resilience and prospective gains becomes increasingly important as prices increase and the purchasing power of money gradually decreases. In order to effectively navigate these turbulent waters, it is advisable to diversify into asset classes and securities that are specifically designed to mitigate the erosive effects of inflation. Investing in tangible assets, such as precious metals and real estate, provides protection against inflationary pressures. Precious metals, such as gold and silver, have historically functioned as dependable buffers, while real estate properties typically appreciate as construction costs increase. In the same way, inflation-protected securities, such as Treasury Inflation-Protected Securities (TIPS), modify their principal value in accordance with inflation, thereby preserving purchasing power and providing the potential for capital appreciation. Opportunities for growth are also present in commodities, such as oil and agricultural products, as their prices tend to increase during inflationary periods. Capitalizing on these price fluctuations can be achieved by investing in commodities through futures or exchange-traded funds (ETFs). Furthermore, by investigating sector-specific investments, particularly in energy, materials, and utilities, you can ensure that your portfolio is in alignment with industries that benefit from inflation-induced price increases. Real estate investment trusts (REITs) offer an additional opportunity for profit by providing exposure to real estate without direct ownership. Companies with strong pricing power can maintain profitability despite increasing costs. Floating-rate bonds can further safeguard your income stream by adjusting their interest payments in accordance with market conditions. By strategically allocating assets and utilizing these inflation-resistant investment options, you can capitalize on opportunities for growth and increase the resilience of your portfolio in the face of increasing prices. 1. Invest in tangible assets. Real assets, such as real estate, precious metals, and commodities, are generally more resilient during periods of elevated inflation. As the cost of construction materials increases, real estate frequently appreciates, thereby serving as a valuable hedge. Historically, precious metals such as gold and silver have served as secure havens against inflation, retaining their value as currency depreciates. By investing in these tangible assets, you not only protect your wealth, but also position yourself to capitalize on their potential appreciation. Real assets provide a practical and frequently profitable method of ensuring financial stability and mitigating the negative consequences of inflation. 2. Invest in securities that are protected from inflation. Inflation-protected securities, such as Treasury Inflation-Protected Securities (TIPS) in the United States, provide protection against inflation by modifying their principal value in accordance with fluctuations in the Consumer Price Index (CPI). This implies that the investment's value increases in tandem with inflation, thereby preserving your purchasing power. TIPS, which offer a consistent income through interest payments and prospective capital appreciation, are a dependable choice for preserving the value of your portfolio during inflationary periods. Incorporating these securities into your investment strategy can improve financial stability and guarantee that your assets increase in accordance with inflation. 3. Consider investing in commodities. Inflationary periods frequently result in price increases for commodities such as oil, natural gas, and agricultural products. A strategic move to capitalize on these price surges can be to invest in commodities through exchange-traded funds (ETFs) that monitor commodity prices or futures contracts. The value of your investments is likely to increase as the cost of these basic materials increases, providing a hedge against inflation. Diversifying your portfolio with commodities has the potential to defend your assets from the eroding effects of inflation and increase returns. This method offers a tangible investment option that directly benefits from the increase in commodity prices. 4. Invest in sectors that are specific to your industry. During inflationary periods, certain sectors tend to outperform others. As the prices of their products and services increase, companies in the energy, materials, and utilities sectors frequently experience growth. Increased demand for basic materials benefits materials firms, while energy companies capitalize on elevated oil and gas prices. Costs may be increased for consumers by utilities, which offer essential services. You have the potential to benefit from the increased revenue and profitability that these companies experience by investing in stocks or ETFs that are specifically targeted to these sectors. This investment strategy is designed to capitalize on sector-specific development trends, providing a promising approach to navigating and profiting from inflationary conditions. 5. Leverage real estate investment trusts (REITs). Real estate investment trusts (REITs) enable investors to invest in real estate without the necessity of directly owning property. REITs typically distribute dividends that are derived from rental income, which can increase in tandem with inflation. providing a consistent income stream. Additionally, the stock prices of REITs may be bolstered by the prospective appreciation of the properties they manage as real estate prices rise. Consequently, investing in REITs can offer a consistent income stream and the potential for capital appreciation during periods of inflation. This renders REITs an appealing alternative for diversifying one's portfolio and capitalizing on the expansion of real estate markets. 6. Invest in businesses that possess pricing power. During inflationary periods, companies that possess significant pricing power can effectively pass on increasing costs to consumers, thereby preserving their profit margins. These businesses frequently operate in critical sectors or possess distinctive competitive advantages that enable them to adjust prices without sacrificing market share. Investing in such companies can be advantageous as they are better equipped to manage rising input costs and maintain profitability. For instance, firms in the healthcare, consumer essentials, and technology sectors exhibit relatively inelastic demand. By choosing investments in businesses with strong pricing power, you have the potential to protect your portfolio from the negative consequences of inflation and take advantage of these companies' capacity to effectively handle economic challenges. 7. Floating rate bonds should be taken into account. Floating rate bonds, which are also referred to as floating rate notes (FRNs), are characterized by interest rates that fluctuate in accordance with market conditions. Interest rates typically rise during inflationary periods, which in turn increase the coupon payments on floating rate bonds. This mechanism of adjustment ensures that the income generated by FRNs remains consistent with inflation. Floating rate bonds can provide a consistent income stream while safeguarding the true value of your investment from inflationary pressures. Their capacity to adjust to fluctuating interest rates renders them an appropriate option for protecting your portfolio from inflation's effects and preserving purchasing power. 8. Invest in stocks that are resistant to inflation. Certain equities are more resistant to inflation as a result of their business models or market positions. During inflationary periods, companies that provide essential products and services, have diversified revenue streams, or have robust balance sheets often perform better. In general, these organizations are more capable of maintaining profitability and managing increasing expenses. For example, consumer staples, healthcare, and utility companies typically experience consistent demand, which enables them to pass on escalating costs to consumers. By investing in equities that have a history of sustained profitability during inflation and enduring economic downturns, you can protect your portfolio from the negative consequences of inflation. By emphasizing these inflation-resistant equities, you can improve the stability and performance of your investments. 9. Invest in commodity-linked investment funds. Commodity-linked investment funds, which encompass commodity-focused mutual funds or exchange-traded funds (ETFs), provide diversified exposure to a variety of commodities, including agricultural products, metals, and energy. These funds are intended to profit from the increase in commodity prices, which frequently transpires during inflationary periods. By investing in these funds, you can access a wide range of commodities without the need to invest directly in each one. They frequently employ futures contracts and other financial instruments that are linked to commodity prices, which can offer substantial upside potential when inflation drives prices upward. This approach to diversification can improve the resilience of your investment portfolio against inflation and assists in the capture of benefits from commodity price increases. 10. Participate in strategic asset allocation. In order to mitigate risk and optimize returns during inflationary periods, strategic asset allocation is indispensable. Diversifying your investments across various asset classes, including equities, bonds, commodities, and real estate, can assist in mitigating the effects of inflation on your portfolio. A well-rounded approach enables you to capitalize on a variety of inflationary trends, as each asset class responds to inflation in a unique manner. Consistently evaluating and adjusting your portfolio guarantees that it remains consistent with your financial objectives and adjusts to evolving economic conditions. By adhering to a dynamic asset allocation strategy, you can more effectively safeguard your investments and capitalize on inflationary opportunities. Conclusion: the strategies delineated in this article can assist you with transforming potential obstacles into profitable opportunities in an environment of significant inflation. You can protect your wealth and potentially capitalize on asset appreciation by investing in tangible assets such as precious metals and real estate. Your portfolio's resilience against rising prices can be further improved by allocating funds to inflation-protected securities, such as TIPS, and investigating commodities. Real estate investment trusts (REITs) offer a method to profit from real estate without direct ownership, while sector-specific investments, such as those in energy and materials, can generate substantial returns. Floating-rate bonds and companies with robust pricing power provide additional opportunities to profit from inflationary trends. In uncertain times, diversifying your strategy through the investment of inflation-resistant equities and commodity-linked funds can provide stability and growth. Lastly, strategic asset allocation guarantees that you optimize your financial performance in the face of inflation by balancing risk and reward across a variety of asset classes. By maintaining a proactive and informed approach, you can confidently navigate inflationary periods and establish a financial advantage. Adopt these strategies to capitalize on the distinctive opportunities that inflation offers in addition to safeguarding your wealth. Let us know in the comments what you think about the how to profit from MASSIVE inflation. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.